Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Craig on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Craig's picture saying, looking for the downloads.
Patrick, Craig had interesting takes on all sorts of commodities, but rare earth elements were clearly the area where he seemed to feel the best trading opportunities existed. So for this week's Trade of the Week, how about showing our listeners how to structure a bullish play on rare earth element scarcity with reasonably constrained risk parameters?
Eric, coming out of Craig Tyndale's interview, the takeaway is straightforward. In rare earths, the choke point isn't mining, it's the midstream. China dominates separation and magnet production, which makes the strategic supply chain trade not a simple commodity beta play. So for this week's Trade of the Week, I want to express that theme through a basket rather than trying to pick a single winner by buying the REMX, the Rare Earth and Strategic Metals ETF. That said, timing matters. REMX is already up about 20% year to date, which makes the entry more fragile and increases the risk of a sharp short-term mean reversion. So instead of running a pure Delta 1 exposure and risking an early shakeout, I want to own the basket and dampen near-term downside volatility. The structure is straightforward. Long the REMX shares paired with a short-dated downside put. The March 20th, 2026 $84 put, roughly 10% out of the money, last traded around $3.28, or just over 3% of spot. You're paying a known premium to protect the early phase of the trade. If REMX pulls back, the put absorbs a part of the drawdown. Now, if it grinds higher, the hedge expires and the premium is simply the cost of the insurance.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's talk equities.
The perceptual pendulum seems to have swung from Trump's on a plane to Davos to announce that he's going to war with Europe, all the way back to, Trump came to Davos and told the audience that there will be no tariffs because the deal on Greenland is already done and the USA will be more than satisfied just to have military bases without taking possession of the entire island. Okay, so suddenly we're seeing a brisk rally, which I think is set to continue until, wait for it, the Trump perceptual pendulum swings back the other way. Now, I have no idea when that will be or what the catalyst will be to bring it about, but I think we've just changed directions on that pendulum, and I think it's bullish for the stock market until the pendulum goes the other way. But the big question on my mind is whether the current bullish swing is going to deliver a new all-time high print, suggesting that this market still has farther to go, or if it's going to be not quite as much as a new all-time high, in which case maybe we're seeing a topping formation here. We should know that within a week or two at the most.
Well, last week, Trump did introduce some short-term volatility with some headlines, but the market quickly absorbed the short-term pullback along its 50-day moving average and has quickly reversed back up. Now, we are seeing an S&P 500 that is generally heavy in its price action. You see the breadth of the market widening. You continue to see the equal weight S&P 500 trading right along its 52-week high like it wants to break out, and a material outperformance in the small cap sector, which continues to make fresh 52-week highs. And so we have overall a market that's being accumulated. But the same thing we've talked about for the last few weeks since the start of the year has been that the Mag 7s remain a substantial drag on this index. You can see that chart on page 4. We're breaking to lower lows as the big leadership stocks are dragging their heels. Now, we were talking talking about the fact that the financial stocks have just started to break down because many of them missed on their earnings, but we haven't yet seen a technical violation on the financials. They could arguably still be bought on dip and stay in primary trend. Overall, this market continues to have all of the signatures of sector rotation underway, not broad selling. Now, inevitably, markets that get heavy and tired, well, it could inevitably turn into a sell-off, very similar like Darius talked about in last week's episode. But overall, right now, the market has not broken or violated any key levels. So retesting highs is still entirely on the table. Now let's move on and talk about this dollar.
Last week, I said that while the Dixie rally had been brisk, I thought it was being fueled by Trump's bold geopolitical moves and was ripe to retrace if a deal was struck and those geopolitics calmed down. Well, sure enough, as soon as Trump announced that there would be no need to tariff 8 European Union countries, all of a sudden the Dixie has retraced much of that rally. So I think we're still in a consolidation range with no clear directional trend, and I think the headlines will determine the next leg.
Well, the dollar breakdown that happened here really was a euro-driven breakdown. A lot of the other cross currencies, while they moved, weren't moving meaningfully. And we still have things like the Japanese yen continuing to break down as the JGB market continues to be under substantial stress. So while the US dollar has definitively turned a little bit lower here, there isn't a lot of clarity that somehow that the downside window has reopened and it's all just going to be US dollar downside from here. There will be looking for signs that potentially it's there. We're trading exactly at the 50-day moving average. I really consider this 98 to 99 zone on the dollar index to be a kind of a fair value zone where there's been a lot of volume that transacted there, and it's spent the last 6+ months trading in a tighter range around that level. And until the dollar shows signs of meaningfully breaking out of this trade range, then I still want to reserve a little bit of neutrality here and assume that the trade range is just prevailing here. All right, Eric, let's touch on oil here.
We're struggling with resistance at the contract 200-day moving average, which is 60.49 on March WTI. We need to see a move above 62.50 WTI in order to really confirm the bull move is on. And frankly, as the geopolitics start to calm down, the risk of a downside retrace toward the $59 and then $55 supports is increasing. So I think the headlines will drive this. Let's see which way it goes.
Well, Eric, the observations you're making on the technical levels line up the same for me. The observation I would make, though, is that oil stopped going down on bad news. And generally, even though we had a quick little pop here on the upside the other week, this entire consolidation has stayed above the 50-day moving average. So while we do have to clear a hurdle in the 200-day moving average, and we do need to see, a bull continuation pattern emerge for there to be any pivot, at this stage, at least the price action is somewhat constructive, and therefore you want to watch closely here whether this does turn into something a little bit more bullish. All right, Eric, we got to talk about gold here.
Patrick, last week I said that the fresh all-time high we just put in on the gold chart would activate measured move targets all the way up to, wow, so much higher above the market, 4,900 to 5,100. I didn't know we'd get almost all the way there in a week. Now, though, what we have is a massive $23 wide unfilled gap way down at 4,600. That's fully $250 below the current market as of recording time. That means that the bull market is still on, but we could easily see a $250+ pullback just to fill that gap in before moving higher. And when you consider that the geopolitical tempo is suddenly calming down, there's plenty of room to see that big pullback. Patrick, you're the options man, so for those of us with outright longs on here as position traders, what's the best way with a hedge or some other trade in order to lock in those gains without giving up the further upside that I'm convinced is still left in this bull market?
While there's different ways to measure out these measured moves, generally all of them overlap that big round number of 5,000, and that's what everyone's looking for here on gold. The fact this year that we've had a rally from just around 4,400 at the start of the year to a stone throw away from 5,000, we've seen a very fast advance in almost a parabolic fashion in the short term. Now, without disputing the long term bull market of gold and the idea that debasement will inevitably draw gold to much higher levels in years to come, there's a short term tactical high very likely to be coming in here, which will spur a consolidation. And the big question here is, should investors do something about it? And like you're suggesting, like what are some of the options? Well, I recognize that this moment, at least on a short-term basis, has a poor payoff profile for new entries. So, a minimum, new participants could be looking for short-term pauses for tactical entries. But investors that are long gold here have a very important decision. Obviously, selling gold has tax implications depending on where and how you hold it. And so, if one wants to hold their core long term holding and just simply put in some guardrails around their gold position from a short term overbought condition, then accept no substitute for just putting on a collar around gold prices. As an example, on the GLD, if you were to collar up your position with a hedge 5% below the market and sell a covered call 10% higher on the strike, giving yourself still ample upside out to March, you can put on the structure for $1.50 cost per share. And so this immediately reduces delta dollar exposures and gives you some guardrails in order to lock in this beautiful advance, leave lots of room for the trade to also keep working. And so this is the one way that you can approach it. Now, if you are willing to tactically sell down your position, as an example, we've been long the GLD through leap positions, which are not these long-term equity holdings. And these, in many cases, these are up several 100%. And so these leap positions have now become very close to Delta 1. In these situations, profit taking the leaps and replacing them with bull call spreads allow you to return some convexity and asymmetry back into the trade rather than holding gold at this stage in a Delta 1 manner. All right, Eric, let's touch on uranium here.
Well, we've already been in a very brisk rally on uranium and uranium miners. Then President Trump at Davos, strongly reaffirming commitment of the U.S. government to the nuclear renaissance, really goosed the market. So this bull market is really taking off. The risk is that we've come up so far so fast that it invites a vicious pullback, which wouldn't even begin to upset the bullish trend. And frankly, chasing this uranium bull with new money way up here is kind of risky unless you're willing to ride out a pretty big pullback. So waiting for such a pullback might be the more prudent time to try to put new money to work on the long side of this market. I'm convinced, though, that it still has a long way to the run to the upside before it's over.
Well, Eric, on page 8, I have that uranium U308 futures chart. And what we can see, uranium is broken out to a 52-week new high. And so we clearly have a new trend in place. The question, of course, is will we see the equities continue to participate? They've also broken out to those 52-week highs. Definitely uranium is working right now. Nowhere near as overbought as gold and gold miners here. So it looks like there's some room to go in this uranium space. I wanted to touch on this copper chart, Eric. And so what we have seen here is that copper has started to get heavy up along the $6 level. And so we saw two attempts to legitimately close above it. And each time it's now given it back. At least some form of a consolidation is happening here. Obviously, the long-term fundamentals are still looking great for copper and there's room for it to go. But after such an extended run on the upside, just, in 2 months running from $5 to $6, there's room for this to pause here and consolidate, maybe even a reversion back to its 50-day moving average for a new tactical buy on dip opportunity.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
This has been an incredibly quiet market all throughout the holiday period. And just last week, we saw the yields wake up with a spike not only above 420, but reaching all the way to 430 on the upside. Clearly, longer duration yields have all reacted negatively. And while the stock market has initially recovered the losses, we're seeing these yields getting, at least for the first few days of reaction, still staying sticky at some of these higher levels.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.